Picture your bank account right now. Whatever number is sitting there, I want you to freeze it in your mind. Because there is one specific number, not $10,000, not even $5,000, that neuroscience, behavioral economics, and Federal Reserve data all agree on, that completely flips how your brain handles money. And that number is $2,000. Not because $2,000 makes you wealthy. It absolutely does not. But because something strange and documented happens in the human brain the moment that balance crosses that threshold. Your financial decision-making upgrades. Your stress response recalibrates. And the way you see your own financial future shifts. Measurably, demonstrably, and fast. Stay with me because the research behind this is wild, and it directly applies to wherever you are right now. Let's talk about what financial life looks like below $2,000, because most people are living it and don't have language for what's actually happening to them. The Federal Reserve runs an annual survey on American household finances. Year after year, it turns up the same unsettling finding. Over 1/3 of Americans cannot handle a $400 surprise expense without borrowing money, selling something, or skipping another bill. $400. That's not a catastrophe. That's a check engine light. That's a kid's emergency room copay. That's a busted water heater. But when you have nothing in savings, even a $400 speed bump becomes an avalanche. Here's how it unfolds. The $400 expense hits. You don't have it. You swipe a credit card you can't pay off. That balance accrues interest. Next paycheck, instead of having breathing room, you're paying down last month's emergency. Then another one hits. You're now running on a treadmill that's permanently set 2 speeds faster than your legs can go. This is not a discipline problem. This is a buffer problem. Most financial advice says start with a $1,000 emergency fund. And yes, getting to $1,000 is genuinely better than zero. A $1,000 buffer neutralizes most single-incident emergencies. Your car needs new brake pads? Covered. Kid chips a tooth? Covered. Landlord hits you with a surprise move-out fee? Mostly covered. But here's the issue, and this comes from Urban Institute research. $1,000 doesn't produce durable behavioral change. People hit $1,000, feel slightly relieved, and then the first medium-sized emergency erases it entirely. And now they're back at zero, except now they've already done the hard work of saving once, burned through it, and feel worse than before they started. The $1,000 feels like a sandcastle. $2,000 feels like a wall. Here's where the science gets genuinely interesting. Researchers at the University of Notre Dame tracked more than 3,000 households with low to middle incomes over a 24-month period. They watched what happened to financial anxiety, decision quality, and saving behavior as emergency fund balances grew. What they found at the $2,000 mark was striking. Households that crossed that threshold showed financial anxiety rates 34% lower than households sitting below $500. Their financial decisions, whether the choices they made actually lined up with what they said they wanted long-term, improved by 28%. And their likelihood of continuing to save over the next year jumped by 41%. Here's the part that should stop you in your tracks. The jump from $1,000 to $2,000 was more than twice as powerful behaviorally as the jump from $0 to $1,000. The researchers named this the nonlinear threshold effect. The second 1,000 does more work than the first. Counterintuitive, but it makes sense when you understand why. When your emergency fund takes a $1,200 hit and you had exactly $1,000, you're at negative $200. You borrowed. You're worse than before. But when your fund takes that same $1,200 hit and you had $2,000, you're at $800. Still breathing. Still in the game. And that feeling, that sense of still being in the game, is not just emotional. It literally changes what your brain is able to do next. Let's go one layer deeper because this is where it gets fascinating. The brain runs what neuroscientists call a threat detection and resource calibration system. Under scarcity, when financial reserves are near zero, this system locks into what you might picture as a red alert mode. It starts overestimating the probability of catastrophic outcomes and underestimating the possibility of recovery. This is why financial stress feels so all-consuming. It's not just worry. Your brain is literally running worst-case simulations on repeat. I'm going to lose my apartment. I'm never getting ahead. One bad month and I'm done. These thoughts feel rational when you're broke. But they're not accurate assessments, they're a brain in threat mode, doing what it was wired to do under scarcity. Here's what changes at $2,000. The threat calibration system receives new evidence. Specifically, evidence that you have a cushion. That recovery is plausible. And when that evidence lands, the brain's operating mode shifts, from threat response to problem solving. And that shift is not trivial. Planning, strategizing, long horizon thinking, all of these require the prefrontal cortex, which threat mode actively suppresses. You literally cannot think your way out of a financial hole while your brain is treating your life like an active emergency. $2,000 quiets the alarm. And once the alarm quiets, you can finally think. Okay, neuroscience is cool. But let's talk about money. Real behavior. Real outcomes. Behavior shift 1. You stop paying the broke tax. Here's a term worth knowing: the broke tax. It's the extra money that people with no savings end up paying specifically because they have no savings. Payday loans charging 300 to 400% annual interest. Credit card cash advances at 25%. Overdraft fees, sometimes $35 on a $12 transaction. These aren't reckless financial choices. They are survival tools used by people who have no other option. The Consumer Financial Protection Bureau tracked average payday borrowers and found they paid over $500 in fees for a loan of less than $400. That's not a loan. That's a financial trap disguised as a lifeline. At $2,000, the broke tax disappears. The emergency is funded. The predatory loan is unnecessary. That $500 in fee stays in your account instead. Behavior shift 2. You gain negotiating power you didn't know you were missing. Think about the last time you had to negotiate something important: a job offer, an apartment lease, a medical bill. Now think about how that conversation goes when you have zero in savings versus when you have $2,000 as a buffer. With nothing, every negotiation is desperate. You need this job. You need this apartment. You'll take whatever they give you because saying no isn't an option. The other party can feel that desperation, and they use it. With $2,000 you can pause. You can say, "I'd like a day to think about this." You can walk away from a lowball offer without immediately spiraling into panic. Research on salary negotiations shows that candidates who signal even a small ability to walk away receive offers 8 to 12% higher on average. That's not pocket change. Over a career, that gap compounds into hundreds of thousands of dollars. Behavior shift 3. Your planning horizon extends. When your bank account is reading $47, you make $47 decisions. You think in days, maybe hours. What can I do right now to not be in crisis right now? At $2,000, your brain starts thinking in months. That extended horizon is the entry point to every financial improvement that actually matters. Building additional income, strategically paying down high-interest debt, investing even small amounts consistently. You can't run a 3-month plan with a 3-hour mindset. The $2,000 buys you the mental real estate to actually plan. Alright, let's talk strategy. Because knowing why $2,000 matters is only useful if you have a realistic path to get there. The single most important reframe: stop treating $2,000 like a savings goal. Treat it like a utility bill. Electricity doesn't get cut because you'd rather spend that money on something fun. Your emergency fund contribution needs the same status. It comes out first, before discretionary spending, before dining out, before streaming subscriptions, before anything optional. Fund the floor of your financial life before you fund the fun. The mechanics are simple. Take $2,000, divide it by however many months you want to take, and make that monthly amount automatic. 10 months gets you there at $200 a month. 6 months means $333. Most people, when they treat this number as genuinely non-negotiable, find a way to make it work. Not effortlessly, but it works. Now here's the strategy most people completely miss, and it's the one that compresses a 10-month journey into potentially a single day. It's called asymmetric income capture. The idea is simple. You have predictable moments in your financial year when larger than usual cash shows up. Tax refund season. End-of-year work bonuses. A side hustle payout. Birthday cash from relatives. The sale of something you no longer need. These events are not random, they're predictable. And the way most people handle them is the most expensive mistake they make. The average American federal tax refund runs close to $3,000. That single deposit, if redirected entirely to a dedicated high-yield savings account at a separate bank from your checking. Not the same bank, separate bank, so it's not one tap away, gets you to $2,000 on a random Tuesday in February. Not after 10 months of discipline. One deposit. Done. But the psychological trap is powerful. When money arrives in a lump sum, the brain reclassifies it as extra money. Bonus money. And bonus money immediately starts shopping for a purpose. New phone. Vacation deposit. Catching up on every delayed purchase from the past 6 months. This is predictable human behavior. It's why lottery winners are statistically likely to be broke within 5 years. The windfall doesn't feel like regular income, so it doesn't get treated like regular income. The countermeasure: decide before the money arrives. Write it down. Literally. When my tax refund hits, the first $2,000 goes to my emergency fund account at separate bank. Pre-committed decisions about lump sums dramatically outperform in-the-moment decisions. Because in the moment, the brain is already spending it. Apply the same rule to every asymmetric income event. Every dollar of non-regular income is a chance to shortcut the timeline. Capture it before your brain has a chance to reassign it. Here's the most important thing I want you to understand before you leave. $2,000 is not the finish line. It's the starting gate. The research on savings momentum is unambiguous. The single strongest predictor of future saving behavior is recent saving success. Someone who has hit $2,000 for the first time is dramatically more likely to keep going than someone who is trying to save for the first time. That first milestone doesn't just change your balance, it changes your identity. You become someone who saves. And that identity shift produces compounding behavior, not just compounding interest. So the moment your balance crosses $2,000, that same day, set the next target. Not next week. Not when you feel like it. That day. Because the neurological window for extending a goal is widest right at the moment of success. 3 months later, the momentum has faded. Ride it while it's live. The path looks like this. $2,000 unlocks the problem-solving brain. The problem-solving brain gets you to $5,000. At $5,000, your planning horizon extends further. $10,000, $20,000, beyond. Each level is a new operating mode, a new set of options, a new version of what's possible for you. But you don't start at $20,000. Nobody does. You start at $2,000. And then you take it from there. The reason I'm starting here, at $2,000 and not $100,000, is because your brain needs a goal it can believe in to start doing anything useful. $100,000 is a dream for someone with $80 in their account. $2,000 is a plan. And plans produce action. You don't need to fix everything today. You need to cross the first threshold. Just the first one. Because everything downstream of $2,000, the clearer thinking, the better decisions, the longer horizon, the negotiating confidence, all of it is waiting for you on the other side of that number. Start there. The rest follows. If this landed for you, share it with someone who's been circling financial zero for too long. And drop a comment. Where are you on this right now? I read them all.